Hey everyone, happy Monday, happy March. It is my market update. It's tough to say happy with everything that's going on in the world, with Ukraine and Russia, but I felt it was absolutely necessary to get on here, share an update about what is going on with the war and inflation, where I think the interest rates are headed. I haven't thought the interest rates are going to go down all year, and then this war comes in and throws a complete curveball, and I'm actually predicting that we are going to go into a recession, and typically after a recession, we see lower interest rates. So I can't say when. If I could, I'd probably be a bajillionaire because I'd be able to predict the future. But I'm going to go over a few charts, numbers about why I'm predicting that. And then, like always, just stay informed. If you are currently in the market to buy a home and you buy a pre-existing home, you're usually in a 20 or 30-day time that you have to lock in on an interest rate and close. We will shop those rates for you, but we've got 20 or 30 days typically. If you're buying a new construction and you've got 6, 7, 8 months, then long-term locks are a thing. I just don't necessarily today would recommend them based on what I think the feds are going to do with the rates and how that's going to cause our economy to probably go into a recession. So let's take a look. The first thing I want to show you guys is this CRB index. And the CRB index essentially measures our global commodities. And what we can see here is in the middle of 2020, we started to see this index increase, which we all felt. Everything started to cost more money, essentially. And that's been going on since the pandemic. In this next chart, I like to look at, this is a very informative chart. It's going to measure a couple of things. This dark blue line essentially measures the stock market, but think of it also as the bond market, which we know bonds are attached to mortgage rates. And what this is showing us is when we're in a recession, what happens to the stock market and what happens to inflation numbers. So let's take a look at this first one. World War I, you can see that after the war, this dark blue line shoots up. The Dow goes up 504%, so the market shot up. But look, the CPI or inflation was up 110%. Then we see it come down. Then we see it climb back up, and we've got World War II. So you can see this dark blue line shoots up another 523% after the war. But during the war, which is the recessionary period, we saw inflation very high. And so we can't say that this is going to happen every single time, but let's just take a look at history. And I was never a history person in school. I absolutely hated history. Now I wish I would have paid a little bit more attention. Anybody that is still in school and taking history classes, pay attention. But what we can see is that there is a trend of when we're in a war, it's typically a recessionary period. After the war, we typically see the stock market shoot up. But during the war, it can be very inflationary and it's expensive. So what does this mean to interest rates? Well, if we take a look over to this slide here, I know lots of numbers and slides. This is going to show us what was happening to interest rates during those same wars and recessions. And what this shows us is that essentially when we're in a recession, interest rates are down. So let's take a look at, let's just say this Vietnam War. So the dark blue line is now the Treasury yield. And so what we can see is that this yield didn't start to come down until about midway through the war. It's not like the war started and we saw the bonds come down. It took a little bit of time. Here's the oil crisis, how happened right away, savings and loan crisis. So I wish I could say I had a crystal ball to say that yes, every time we go into a war, interest rates go down. I can't say that. But what I can say is that typically when we have a war, we see a recession. And when we're in a recession, we typically see interest rates drop. So that's what I am leading to, why I think interest rates aren't going to continue to increase. I actually think that we're going to see them decrease, which is something that I didn't think that I would say. If you would have asked me 2 or 3 weeks ago, there's no way I would have said that. I thought that they were still climbing. But then we had the curveball come in with the war, and that leads me to this chart here. This is super, super important. This is how economists measure inverted yield curves. And so what the heck does that mean? That basically means that the 10-year is trading lower than the 2-year. Which is not normal. Usually it's reversed, but inflation is like the biggest fear for investors who commit to a 10-year investment, because if you lock in at that 10-year at a 2% rate, but inflation goes up, let's just say 3% each year, well, now you're not making money. You're actually losing money. And so what this is showing us is we're not quite here at this red line yet to be at an inverted yield curve. Where I think we will get there is the Feds are supposed to be meeting this week. If they increase the federal funds rate, which has nothing to do with mortgage rates, but if they decide to increase the federal funds rate, then I think that that is going to cause the 10-year to come down, and therefore we will be in an inverted yield curve. And guess what? The last 7 times that we have seen an inverted yield curve, we have gone into a recession. And remember, recessions usually mean lower interest rates. So do we think the Feds are still going to increase the federal funds rate like they've been threatening all year? Well, let's take a look at this chart. What we can see here is we've got the market in February, then we've got the gray line, which was the market February 28th, and then we've got JP Morgan. So it just gives you a couple different indicators of what do we think the Feds are going to do to this federal funds rate. Here's March 2022. You've got June, July, September, November, December. Look at this. By the end of the year, we're predicting the federal funds rate to go up about 175 basis points. So what do you think that that's going to do to the 10-year bond? This, to me, is going to cause an inverted yield curve, which means I'm predicting that interest rates are going to actually go down. So again, no crystal ball. Who would have thought that this would have happened with Russia and Ukraine? We will keep you updated and informed. As you guys know, every Friday I do post an updated rate sheet that lets you know roughly where interest rates are. Every rate is dependent on each person's scorecard. When we lock in, the bond market, all that stuff. Nobody's scorecard is the exact same, not even identical twins. So it's really important you're working with a lender that studies the market, knows the market, and can advise you when a good time is to lock. So stay tuned. Put your seatbelt on. 2022 is going to be a rough year. But I will say, if we do go into a recession, it's not great for the economy, but it's good to keep interest rates down. So stay tuned. Until next month.